on operational accountability. And what do they contain? Business type and governmental. Any fiduciary? You know, I'm going to ask you that again. I love that question. Any fiduciary? No. All right? Expect a 99.999% response on that. Okay? No fiduciary. Okay? And what's the basis of accounting? Accrual? What measurement focus? Economic resources? Right? Okay, you got the gist of it. Now, what I want to do is, if you ever have the fortune of actually doing these statements, you will be, it's a little involved, but I'm going to try to keep this very simple. There isn't one accounting package out there, SAP, Oracle, where you can push a button and say, produce statements on modified accrual basis, and push another button which says, produce statements on accrual basis. You've got to figure this out yourself. So this is what happens. What is, if you were the CFO of a governmental organization, you had a choice between two bases of accounting, modified as opposed to full accrual, which one would you pick? Practically. If you have budgets and you have others, you've got to use modified accrual because that's what budgetary accounts, remember we talked about budgetary accounts? So now you pick one or the other. Let's assume you pick the modified accrual. How do you get to the accrual basis now? Well, what we do actually is, in practice, we produce a trial balance on the modified accrual basis. And then we take these steps to convert it into full accrual basis using a spreadsheet package, using our own spreadsheet program. Very involved, takes a lot of work, and nobody wants to do it. But that's the only way to produce accrual statements. Isn't that surprising? Aren't you surprised that there isn't a software package which just takes this and doesn't do it? Because of some of the things which we'll talk about. Okay? Let's talk about the first thing. Modified accrual basis. Do you record depreciation in modified accrual basis? If you had to prepare on an accrual basis, what would you have to do? Adjusting entries to record what? Annual depreciation. How about interest? Do you record interest the same way under accrual and modified accrual? So if you had to record it, if you had to prepare government-wide statements, what would you have to do? Do an interest accrual, okay? Receivable or payable, mostly in our case payable, okay? What else do? You close all the program and general revenue expense and you reclassify, and I'll get into this in a moment or so. And let me show you. I'm trying to keep things as easy as possible here, but let's go to page 368. This was a trial balance that was taken. In order to close accounts, why are we debiting these accounts, program revenues, all these revenue accounts? Because to close them, what do you have to do to a revenue account? Zero it out. And what do you do to expense accounts? And what do you do with the difference? Net position unrestricted, right? Is that good or bad, having a debit like that? Net position. Were our expenses greater than our revenues? Yes, right? Do you understand the basic entry, the closing entry, right? Okay. Now the next thing is, remember when we looked at the government-wide statement, the statement of net position had how many different components? It had 3. Somebody said 3. What was it? Amount invested in what? Capital assets, net of debt, restricted and unrestricted. Now what has to happen, and this is, try to see if you can follow this. When you are dealing with a corporate entity, there's only one line, retained earnings. You just throw it in there. With governments, you have what? These 3 lines. It's like a pie with 3 slices. Every year, you have to readjust the size of each slice. Every year, you have to readjust the size of each slice of the pie. Why do you have to do that? Let me explain. If your amount invested in capital assets was, net position, net investment in capital asset last year was $1 million. You just bought another $1 million worth of assets. What's going to happen to that number? The amount invested in capital assets. It's going to go up from $1 million to $2 million. So what happens to the slice? It gets bigger, right? What happens to the restrictions? If you have debt service funds which were $500,000 last year, but now you only need $250,000. What do you have to do? Adjust the slice down from $500,000 to $250,000. If you get those 2 parts, you automatically get the third part. If you know the size of the pie and you know 2 slices, you know what the third slice is. And this is what's happening here. Here, what they're doing is they are transferring amount from, maybe I should show you this at the top so you could you guys, can you read this at the top here, or? Just bear with me, as I said, for a minute. Just try to see if you can get through this, okay? Net position, net investment in capital asset. What happens when you debit a equity account? Are you reducing it or increasing it? Good. And so what are we doing? We are reducing this slice by this and increasing what? The unrestricted. Because we have to adjust the unrestricted each time, right? What are we doing here? Net restricted for debt service. Are we increasing it or decreasing it? We're increasing it. Do you see what we're doing? We're adjusting the slice each time. Take a look at this example. Once again, I'll repeat this. At the end of the year, you need to determine what the correct amount is in your net position, amount invested in capital assets, net position which is restricted, and net position which is unrestricted. At the end of each year, you have to do that. And this journal entry on page 369 shows you how it happens. Anytime you change the size of a slice, you have to change the size of the unrestricted, because that's the one which is left over. So if you increase amount invested in capital assets, you have to do what? Decrease the amount in unrestricted, and vice versa. Okay. I hope you got that, because it's a little, it's not easy. Believe me, I understand that, but it's not impossible either. Okay? All I'm telling you is that when you close your program revenues and program expenses, there's something left over, right? That gets added to the pie. And then after that, you slice it based on the facts. Okay? And this is what happens in practice, by the way. So it's not something that's shown here only. And this is what we're talking, entries to reclassify as necessary, these items. Let's talk about the fund financial statements. Sorry. They use what? Modified accrual basis. Now, let me tell you this because some people might get confused with this. Unfortunately, it's the terminology. That's what gets people, you know. Fund financial statements. When you talk about fund financial statements, most people think of governmental funds. Governmental fund financial statements, which use what? Modified accrual basis. Unfortunately, there's something called proprietary fund financial statements and fiduciary fund financial statements. Do they follow modified accrual basis? No. They follow what? Accrual basis. Don't get confused with the word fund financial statements, because it could mean what? Both modified as well as full accrual. If I said to you governmental fund financial statements, then it's what? Modified accrual basis. Okay, so there was a couple of years ago, the Governmental Accounting Standards Board issued a new standard, GASB Statement Number 54, which changed the way you show fund balance. Now, I want you to just think about this. In the government-wide financial statement, what's the equity section called? Net position, right? In the government-wide financial statements, what's the equity section called? Net position, right? In the fund financial statements, which is the balance sheet, what is the equity called? Fund balance. You see the difference? One calls it what? Net position, and the other one calls it what? Fund balance. Net position was divided into three, right? Parts, which we just talked about. What's the fund balance divided into? These 5 parts. Get it? The net position was divided into 3. Fund balance is divided into 5, and I'll explain that to you. There's 1, and then there are 4 within the second category. So what's non-spendable? And this was one of the questions I had asked you. What's the fund balance? Assets minus liabilities. What does government use? Flow of financial resources. Very much like cash. So assume for a moment, if everything was cash, assets minus liability tells you what? How much cash you have left, right? Or near cash, right? If you have inventories under your assets, now you've got an issue, because you say fund balance. That's going to show the amount of inventories, because it's asset inventory is included in assets. So what I'm saying to you is GASB came up with 2 different categories of fund balance. One that you can spend and one that you normally don't spend. Can you spend inventory fund balance? No. So it's called what? Non-spendable. So if you have inventories of $10,000 on your balance sheet, what's going to be your fund balance non-spendable on the balance sheet? Exactly the same number, because you can't spend it, right? If you have, again, let me give you an example. If you have $10,000 in your inventory account on the balance sheet, what's going to be your non-spendable fund balance? Exactly 10,000. Because it's assets minus liability equals fund balance. So that's why we call that non-spendable. Now let's take a look at spendable. These are the categories. Now many years ago, I can remember, before things got really complicated, we used to have a great time at the end of the year. The question was, how do you hide money? Why do you want to hide money? Because you don't want folks to say they've got all that money, have them spend it. You wanted to keep what? Monies in reserves for contingency, not to give yourself bonuses. But what was it? It was to allow you to meet unforeseen expenses. Okay? So Gatsby thought leaving it to CFOs to figure out what was restricted, what was unrestricted, wasn't going to work. Because there are some people who are very loose, and there are some people who were very careful. And the auditors were pulling their hair out because they didn't know what to do. So Gatsby came up with this statement number 54, which basically said the following. You have 4 categories of spendable fund balance. And we'll start off with the first one, which is restricted. Restricted fund balance is a fund balance which is constitutionally or by legislation restricted, meaning it's designated for a purpose and it's done outside your organization. It's written in law. It's through some outside law. You have no question about it. Tells you $1 million of your fund balance is for that. That's what it's for. And you have to show it as restricted. The next one I see is committed. This is now based on the highest level of decision making. What is the highest level of decision making for a government? The board, right? The board of directors or board of commissioners. If they say, you know what, it's to be used for this purpose. We want to do this expansion next year of this building, and you're going to dedicate this, and we're going to pass a resolution dedicating it for this amount. It becomes what? Committed. See how it's come down from outside to now inside. How about our CFO? The CFO says, okay, I've got my share too. What I like to do is I like to save this money for maybe upgrading my computer system. That's not at a lower level, right? But it's still a CFO or a financial manager, right? From the board, you've come down to what? The CFO or financial manager. That's called assigned. And anything that's left over is unassigned. Those are the 4 levels. And you need to know that. Everybody got that? And that's what that is. I have to tell you one thing, which is, and let me see if you get this. Yeah.
So the difference between assigned. Thank you.
Yeah. Committed is when it's done at the organization's highest level, which would be the board of directors or board of commissioners. Not people working in the organization, but those who basically are responsible for running it. Okay? And the assigned are those people who are senior finance managers who can make that decision. And unassigned is everyone else, or no restriction. Okay? Now let me ask you a question. What was capital projects fund used for? Was for construction of large assets, right? Construction projects. They also have a fund balance. What do you think? Do you think you can ever have an unassigned fund balance in a capital project fund? Just think about it just logically. Can you have it? And you're right. How about the fund balance in a debt service fund? Can you ever have unassigned fund balance in a debt service fund? No, because it's used for what? For debt service. So if you have some money left over, it's still going to be used for debt service. So what I wanted to tell you was unassigned fund balance can be found in special revenue fund and general fund, but not in capital projects fund or debt service fund. So far, so good, I guess. Okay, we just talked about that. Now let's take a look at the next part. And this is on page 376. But before I go, let me explain this to you. What are the two operating statements? Statement of activity and statement of revenue, expenditures, and changes in fund balance. Do they have the same numbers? No. Statement of activity is on what? Accrual basis, and statement of revenue expenditures is what? As a reader, would you like to be able to reconcile those two statements? Yes. How about the balance sheet and the statement of net position? Do they show exactly the same numbers? No. Would you like to reconcile them? Yes. How many reconciliations do you have to do? 2. Between the government-wide and the governmental fund statements. So let me ask you this question, and I'm going to have you do this in your head. When you spend money on a capital assets in governmental fund, do you capitalize it or do you expense it, or does it just show up as an expenditure under governmental funds? Governmental funds follow what? Modified accrual basis, and therefore what do? It shows up as an expenditure. In the government-wide, what do? You capitalize it. If that was the only difference between those two statements, will you be able to reconcile them? Yes. What would you do? From the modified accrual basis, you just subtract $1 million, and it will give you exactly the same result as the other. And this is what they do. And I'm going to show you this reconciliation on page 376. And I'll tell you what you need to concentrate on. This is just reconciliation of the balance sheet to governmental fund statement of net position. Just watch this for a moment, okay? What was the bottom line in the balance sheet? Fund balance was 281. What was the bottom line net position? 17 million. You say, and this is what drives people bananas. They say, you know, there could be nice to just see a little difference. How could you have two statements be so different? One showing what? 281,000 as your equity, and the other one showing what? 17,211,000. And this has been really, actually, there were a couple of people at Harvard University who wrote a working paper on why GASB was going nuts with the new financial reporting model. Because their contention was you have two operating statements or two statement of positions showing such different numbers. Which one is it? And this is the reconciliation. They start with 281, amounts that are reported which are different, capital assets. Why did we add it to 281? Because what would we do? We would expense it, right? We would subtract that. So now what do we have to do? We have to add it back. And these are the adjustments that go through it. I'm not going to ask you to do this exercise, but I expect you to know a couple of things. What makes modified accrual basis different from accrual basis? Capital assets, right? Issuance of debt, right? Depreciation, right? Those are the three principal things. There are others that show up, but basically it's capital assets and long-term liabilities, and you see accrued interest payable. So those are the three items. That's what I want you to know.
Can you repeat that?
Yes, the capital assets, the long-term debt, and accrued interest payable. Okay? Those are the three things which make the two statements different. Let's go down to the bottom part. And guess what? The bottom has the same thing except for we have the capital assets, we have the debt service, but then we have some other things. And let me explain this to you too. Under the operating statements, remember that question I asked you? What's the Gatsby rule on accrual of taxes? How many days? 60 days. What happens after 60 days? It goes into the next year, right? What about full accrual basis? No limit. So you could have different numbers for revenues under two different bases. And that's what that is adjusting for. Okay? Revenues and expenditures, I know this is kind of, I see people stretching, I see people just getting, but bear with me. You'll get this, okay? I'll make sure you get it before you leave, okay? Which is that you need to be able to the purpose of this exercise is to identify items which are different. And what are they? Capital assets, long-term debt, accrual of interest, recognition of revenues, and recognition of expenditures. That's what makes things different. Okay? Okay. Capital assets, long-term debt, accrual of interest, revenues that are shown differently under modified and full accrual basis. And I gave you an example, property taxes are one. And expenditures which show up differently under modified accrual basis as opposed to accrual basis. Okay? So those are the 5 things that come to mind. I'm not going to ask you to do such a reconciliation because I'll tell you, when I did this and I reviewed this, I would scratch my head half the time and try to figure out how I'm going to get this thing to balance. Okay? But it can, it's done. It's done by accountants. So by hopefully those who know what's going on. Okay. Couple of other things, and then we'll take a break. I think it's too warm in here.